Hello and welcome to Sustainable Finance in a Pandemic, brought to you by P.R.I.M.E Finance. My name is Camilla McPherson. I'm going to start today's session with some housekeeping. Attendees are muted and have their video switched off. If you have a question or comment, we'd love to hear from you. Please use the Q&A function to get in touch. It can be helpful to include your name and affiliation. Questions for the panel will be answered towards the end of today's session. And we'll use the chat box to send messages to all of you during the course of today. I'd like to thank Dwell Financial Technologies, FTI Consulting, Morrison & Forster LLP and Rutter Associates for sponsoring the second series of Prime Time. Thank you also to Channel Capital Advisors for sponsoring this session. I'd also like to thank Lexis and MLEX for their support of Prime Time and assistance with promotion. Now, this is the last session of Series 2 of Prime Time, but at the beginning of December, we're having our first Asia conference to be held virtually over 3 sessions, and we'd be delighted if you could join us. I'll put the sign-up links in the chat box once we get underway. It now gives me great pleasure to introduce today's panel. Ida Levine is moderating. She's principal of Two Rivers Associates and sits on the board of the Impact Investing Institute, an independent non-profit organisation which aims to accelerate the growth and improve the effectiveness of the impact investing market. She's a former board director, senior VP and senior counsel at Capital Group, former European counsel at JP Morgan Investment Management and a former partner at Jones Day. Last but not least, she sits on the board of the P.R.I.M.E Finance, she's on the P.R.I.M.E Finance Management Board and she's a P.R.I.M.E Finance expert. Next, we have Meryam, who's Head of Sustainability and Responsible Investment Strategy at Legal and General Investment Management. She's responsible for integrating environmental, social and governance aspects into the investment process. She led the launch of LGIM's Future World Fund range and Climate Impact Pledge engagement programme. She also sits on the advisory board of the Finance Dialogue on Climate Change. Jonathan Maphosa is founder and managing partner of Maphosa Attorneys, a law firm based in South Africa with expertise in, amongst other things, banking and financial services regulation and environmental law. He is the former Nedbank Group Chief Legal Counsel and former General Counsel for BankServe and also a P.R.I.M.E Finance expert. And finally, we have Wendy Miles, a counsel and arbitrator at 20 Essex and Vice President of the ICC Court of Arbitration. Wendy frequently acts as counsel in relation to climate change transition, disclosure, reporting, compliance, and investment issues. She also regularly advises investors and states in respect of climate-related risk, and she's a P.R.I.M.E Finance expert. I'm now going to hand over to Ida to give an overview of today's session. Thank you.
Thank you very much, Camilla, and good afternoon. Welcome to our session on sustainable finance in a pandemic. This is a really fast-moving area with many developments over the last few years. The EU has been the thought leader with its ambitious Sustainable Finance Action Plan. But now the UK Chancellor, Rishi Sunak, signaled that the UK will be looking at ways to underline its commitment to the green agenda in the run-up to COP26 next year, including mandatory reporting on green issues for PLCs, banks, insurance companies, and pension funds, and a green sovereign bond. On the tails of the COVID pandemic, policymakers around the world are looking to build back better, with an increasing emphasis on social issues. We have a great panel who will cover this topic from a number of different angles. First, Meryam will set the stage. She'll tell us about frameworks and environmental and social drivers and how COVID has influenced the landscape. Looking at the bright side, Jonathan will look at opportunities presented by sustainable finance, new products and practices from swaps to green bonds. I'll be covering the topic of a just transition and how you balance green and social impacts and the economic impacts as well. And Wendy will close the loop for us, covering the risk side, issues around litigation, and the future of dispute resolution in this area. So now over to Meryam.
Hello, everyone. So the question is, how has the sort of the huge demand for sustainable finance over the last few years has fared under this pandemic strain? And the simple answer is, it's hotter than ever. Since April, we have not stopped answering questions about how the ESG sustainable funds have been popular. And that's partly because we're kind of starting to see a glimpse of what climate change can do to the world, which is kind of a scary world. And we are starting to realize that we have in terms of impacts globally. And also because a lot of sustainable investment funds have actually performed quite well in this period. So the demand for this kind of products is continuing to grow. So that's good news. The fact that what's happening right now is very terrible. What I like to do is just kind of set a little bit of a scene about what I mean by sustainable finance, because it's a world of quite a few jargons. So I want to kind of break this down for you. So let me just share my screen. Okay, so there is a bit of a spectrum in what we call sustainable or responsible investment. On one hand, we have what we call kind of exclusionary funds. This is sort of people's personal opinions. I don't want my money being invested in tobacco or coal and things like that. And those people tend to say, well, it doesn't really matter what the returns are. I just don't want my money going there. And that's fair enough. In the middle of it is what we call ESG integration, environmental, social, and governance aspects. And what we mean by that is when those things can impact the bottom line of companies, what we call financial materiality. If some of those environmental components start to impact the company's operations, then we should be incorporating that into the investment process. Kind of a no-brainer, but it actually took a long time to frame it properly in a fiduciary context, which I'm going to talk about. And the third part of it is, yeah, I want the return, but most importantly, I want to know what impact I'm having through my investments. Protect the return, but also, can I have positive returns? And that's the world of impact investing. So you got personal values, you got financial materiality, and you got societal responsibility. So I'm sure you can appreciate this is a huge spectrum. It's really hard to kind of say in one word what is sustainable. And what I want to talk about today is really about where does law and the legal framework sit in relation to the responsibilities that we have as investors. To put it quite bluntly, the only area that's quite firm now, firmly kind of clarified, is the middle bit, financial materiality. And that makes sense because we're here to give returns to our clients from, by managing their money. And if that impacts the bottom line, then you should be incorporating. So that is something that's kind of easy to understand. Believe it or not, it took a long time for us to say that in the UK and some of the other jurisdictions. So in the UK, we now have a clarification that the so-called fiduciary duty, and I say so-called because there's so many kind of legal interpretation of it, but the responsibility we have should be incorporating ESG and climate change where it's financially material. Now, I say that it's sort of easy said than done because actually that definition doesn't exist, for example, in the US currently, and it doesn't exist in many other countries in Asia. What that means that ESG and sustainability is not understood to have financial impact. So we still have a bit of a long way to go in terms of kind of putting the proper framework of accountability and responsibility on investors to look at sustainability issues. But coming back to the kind of exclusionary funds, the personal value part, there are some movements. For example, in Europe, what the regulations are starting to say is that advisors and consultants should start to really incorporate people's views, do more surveys and go out and ask, because people have views and we should try to incorporate that as much as possible. So that's a development that's starting to happen in Europe. And on the other side, there is a huge amount of work happening in the impact space as well. And in this case, in Europe, also starting to look at double materiality. this is when not only we look at how companies are impacted by climate change, that's sort of the ESG integration part, but how companies are impacting climate change. So, the broader impact. And so the question here is starting to really look at how far should the responsibility of investors go? Surely the middle bit is more or less is in the remit because that impacts the return. But even within climate change, there are many, many things that don't have material impact as of yet, like water issues. Because there's no price on water, it's very difficult to incorporate that into investment process. And biodiversity, cutting down trees doesn't have a direct impact. So there are many things within climate change that is really difficult to directly link into financial materiality. So we've got a work to be done. But if you were really to expand the remit of investors, then we need to really think about the legal frameworks that we have. Can we have a mandate where we go, please give this return, but also have a positive impact on society? Can we start to think about that kind of legal framework going forward? So that's, one of the conversations I guess we're going to have today as well. Now, I talked a little bit about returns earlier on. This is a chart of the ESG, environment and social funds, assets under management that have grown over time since 2010 up to 2019. And what you see is huge jump, and that's estimation, and maybe that's my expectation, but also maybe hope. But I think it's fair to say that the growth for ESG funds is just phenomenal because so many clients are asking for this kind of funds that incorporate ESG. And why? Well, this is an interesting chart that is a relatively short period of mainly 2019. But if you look at the y-axis, you've got the net flow, how much money is coming into ESG funds, the pink, and then the non-ESG funds, that's the orange, against the performance. And on both fronts, ESG is outperforming. So they are outperforming in terms of return. And I guess as a result, they are attracting a lot more assets coming in as well. But I do want to say, what I definitely don't want to say is that if you do ESG, you're going to outperform. You should never say that. And this slightly complicated chart shows you the kind of difference in returns you can have from ESG funds as well. So this is regional ESG index block. So this is compared to a non-ESG index, how much of that ESG tilt that we've created in the fund has kind of contributed to outperformance or not. So it's starting from 100%. If it goes up, that means you've outperformed as a result of ESG tilts. Now, what you see here is quite a lot of variations between the different regions. So in this case, North America has outperformed, UK, not so much. So what I don't want to say here is that kind of the false comfort that if you do ESG, you're going to outperform. But at the same time, I think what this period of pandemic has shown is that the whole principle of ESG, which is the companies that address environmental and social and governance aspects, are more likely to withstand, kind of times of strain like right now. And that has actually proven to be the case. And so I think what long-term investors are looking for is these kind of companies that are addressing sustainable issues. And the one last thing I want to say that is really pertinent to the pandemic period is the fact that we've sort of focused on climate change, so E, the environmental part of it, but the S, the social aspect, has become a lot more under spotlight, which is really about how companies, address its own employees, how it handles supply chain, the strength of supply chain with Asia and so forth. All of that have come under pressure. And so not only ESG funds continue to be popular with our clients because of E, but I think the S component, which I think Ida's going to talk about later in terms of just transition, has become a lot more interesting to our clients, and we will see a lot more developments in this area. I'll stop here now.
Thank you very much. That was a great introduction to the topic. On to Jonathan. What are the new products and processes?
Thank you very much. So I thought as a starting point before delving into all of the products, it's just, just to recap that the term sustainable finance within itself is very, very broad. So this would encompass, your financial models, the services, products, markets, ethical practices, and I could go on and on. So obviously the focus here is just on the product sets, what's exciting, what's new in the market. I know in your introduction, Ida, you mentioned that derivatives would have a play here, and I absolutely agree. Because of the nature of derivatives, the cash flows of derivatives are derived from the performance of the underlying. So I think there's a huge role for derivatives going forward in terms of hedging risks associated with ESG. And I think especially within Europe, in the Europe environment, I've picked up a couple of articles from the European Capital Markets Institute, which seems to suggest that there's a growing trend to start hedging using derivatives in this area. And I think coming into the broad new product sets, I think green bonds have received a lot of attention because naturally they have been sort of the most subscribed of the sort of green products that are available. But I think they're probably one of 6, and I categorized sort of into 6 key sort of products that I see emerging in this space. The first would be your sustainable bonds. So this would encompass environmental, social, sustainable bonds, your sustainable green loans, where the proceeds from these loans are used for green products only. Sustainable equity, and there's huge demand for this, more including in emerging markets. And in this instance is where people or investors are looking to invest into green technology, or where they want to spread their investment risk, would look for a sustainable index fund within which to invest in. So a lot of new activity in that space. And then so your sustainable linked loans, this is where the interest rate would typically be linked to your ESG performance as an institute. Now that becomes very exciting in terms of, if you look around and note that there's been a lot of shareholder activism around, what are these corporations doing to enhance their green footprint? Are you simply greenwashing? And I think this then creates a good incentive if you're taking up sustainable linked loans to actually perform against these kind of initiatives. From a South African perspective, and maybe just to bring it home a little bit, if I look at the most popular would be the green bonds. The first green bond was sort of launched in 2014. The Johannesburg Stock Exchange has got a section which they call sort of a green segment section. And there's been quite a bit of activity in that respect. From a trajectory perspective, I think a lot of the banks have put out green bonds. I spoke about this at the last P.R.I.M.E conference, and there was huge excitement in the room around what's the timeline from setting up the bond, socializing it in the market, doing a roadshow, to actually getting it listed on the green segment. And I would say what's quite exciting in the environment is that timeline is starting to shrink. So there's a huge advent of new products coming out on that green bond segment. But I just wanted to also, maybe just as I close, take a bit of a case study. And Barclays has come up with what they call a green product framework, right? And for people interested on the panel, you can just spend some time looking at this. And what's exciting, what I find particularly exciting about it is it's product agnostic, right? So it presents a framework which sets out the underlying eligible qualifying environmental themes and activities which a bank would look at. And they would look at these in assessing for risks. It would serve as a guide from a risk perspective, from a policy perspective, from a verification and ongoing assessment perspective. So I think, if one is looking for sort of what are the new emerging frameworks that the banks are adopting in order to assess and even, dictate on reporting and the development of these kind of category of products, that would present to me, in my mind, one of the better case studies from a green product perspective. And in terms of local regulation, I don't know if we have time, maybe we'll touch on that a bit later. I'd like to just mention that there's also within an emerging market environment, particularly in Africa, a number of concept papers. I could speak to from a South African perspective. In May of 2020, the National Treasury released a paper on financing a sustainable economy. And I believe the intent of this paper is to really acknowledge that there's a definite need from a regulatory perspective to intervene in terms of, and I'll go into the detail, but just in the interest of time, maybe we can touch on that a bit later.
Okay, thank you very much. We will have 20 minutes for questions at the end. I hope the audience is saving them all up. We can come back to Jonathan. We can also talk a bit more about the detail and some of the policies and regulations that are out there. I'm going to quickly cover the topic of just transition and what it means and how you can balance the green transition with social and economic priorities. The objective of the just transition is that no one will be left behind in the green transition. Moving away from fossil fuels like coal, lignite, peat, and oil shale can be difficult. In fact, coal remains a major political bottleneck in the EU, and the EU is where the whole concept of just transition has originated. Close to 1/5 of the energy in the EU is still produced with coal. And in some countries, coal is still predominant. So there is a bit of a quandary. There are green ambitions, but there is a big impact of fossil fuels on the economy. The just transition recognizes that the transition towards a climate neutral economy may have these negative and social and economic effects, and it looks to handle these in a fair way. So, for instance, it seeks to provide financial and practical support to help workers and look after the social welfare of those who stand to lose their jobs. Also, to aid in the socioeconomic transformation of affected regions. So, for instance, that might mean building infrastructure, economic diversification, and conversion of industry in the regions. Also, reskilling workers, creating green jobs, and generally speaking, figuring out ways to address these negative social and economic aspects of the green transition. The EU has funded something called the Just Transition Mechanism, providing funding to EU countries in their transition to a net zero economy. There's a fund called the Just Transition Fund, which matches regional and member state funding. And there's also a loan scheme and an investment scheme. At the moment, the funding is caught up in the EU budgetary process for 2021 to 2027. It was very ambitious at the beginning, 43 billion euros, was cut to 17.5 billion euros. And we're now looking at a tussle between the Commission and the European Parliament, and hopefully that amount will be raised. As I said, it provides backing of SMEs, funding for research and innovation, upskilling and reskilling programs, job search assistance, creating green jobs, and mobility and pension bridging grants. So it's very practical funding to try to make the transition as comfortable socially and economically as it can be for all. So that's my summary of the just transition. And on that note, I'm going to hand over to Wendy, who is going to close the loop and talk a bit about the risk side and potential litigation, dispute resolution, and arbitration in this area. Thank you, Wendy.
Thank you, Ida and Meryam and Jonathan. Terrific. So I'm going to focus on two sources of legal risks, duties and responsibilities. There are others, but I'm just going to focus on two. And they're both also, as is often the case with risk, sources of opportunity. So I'm going to focus on fiduciary risk and contractual risk. Now, regulatory risk, and I see there's a question in the Q&A about regulatory risk, but that provides an overlay to both fiduciary and contractual risk, but that's what I call an objective risk. Fiduciary and contractual risks are subjective. Both of them are impacted by the particular investment decisions of a particular financial institution or investor and how those decisions are implemented. So if both fiduciary and contractual risks, they're assumed by the investor through a consensual legal relationship. Fiduciary arises by dint of the business relationship. It may be a trustee and beneficiary relationship or a corporate board members and shareholders, for example. For our purposes, an investment fiduciary is anyone who has legal responsibility for managing someone else's money, such as a member of the investment committee, but it's much broader. As to the scope of that legal duty, a fiduciary is legally bound to put its client's best interests ahead of its own. Now, it's where sustainable investment meets fiduciary duty is precisely in the middle of Meryam's line on her first slide. This is the ESG integration point, the financial materiality driver of fiduciary risk. That's what plays into that risk. The contractual relationship, that arises through a legally binding contract. So let's take the standard form investment management agreement, or the IMA, just for example. This is a bilateral relationship agreement between an investment manager and a client. And the manager and its agents have discretion over all matters pertaining to the fund or assets, administration, management, or investment strategies. As to the scope of the legal duty there, under an IMA, for example, the current standard IMA provides for a standard of care that could reasonably be expected of a professional discretionary investment manager acting in good faith and with reasonable care and skill. That's how it's defined in the contract. That definition is a choice by the parties. This, if you like, these contractual relationships can inform the two ends of Meryam's line, where you have either the exclusionary funds, they are chosen by contractual agreement, or the other end of impact investment. That too is a choice made by the client. So investment companies have long been the largest investors in the domestic financial markets for the past 20 years. And in recent years, they've held a fairly stable share of securities outstanding across a wide variety of class assets. Mutual funds, about a third in the US, about a quarter of US Treasury government agency securities, and so on. And this is why they come under huge pressure to transition their investment portfolios to net zero. But in order to achieve that, these investment managers, financial institutions need to avoid, or at least to minimize, their own fiduciary or contractual breach risk arising out of their transition investment strategy choices or their sustainable investment choices as investment managers. Because here's the thing, we're in a transition. A transition, by definition, it's a movement, a passage, a change of one position to another. This is a period of disruption. Disruption exacerbates risk, but it also accelerates opportunity. So I mentioned the overlay of regulatory risk, which I call objective risks. And what I mean by that is that regulatory risk is imposed by the state or the government, and it's outside the control of private actors. Governments make regulation and private actors must comply when they do so. The struggle for transition, and Meryam touched on this when she talks about ESG integration being so difficult, the struggle for transition has been the slowness of the emergence of a legally binding net zero regulatory regime anywhere. So for example, the TCFD on climate disclosure and reporting is voluntary. So and that contrasts to the relatively proactive response of investors. So I can't solve the regulatory lag, and frankly, neither can corporates, including investment managers. But that's something for government and democratic processes we can advise and recommend. But precisely the same balancing that's going on in that sphere between legally binding action and non-binding noise, that same balance is playing out in what we can control, the fiduciary and contractual risk space. And this is in the power of private corporates, financial institutions, where they can align legal risks, duties, and responsibilities with their sustainable investment aspirations, ambitions, and representations. How do they do that? Through their contracts. So I mentioned the IMAs, and most investment managers have some form of investment management agreement. That's a contract. I know the standard form, they're often not thought about too much, but it's a contract. It defines the duties and responsibilities of the parties and their rights. And there's no reason why such contract can't incorporate a contractually agreed right on the part of the investment manager, and yes, I said right, to make sustainable investment choices as a priority. And that's precisely what happens of a form for exclusionary funds and for impact investing. So why not just contract with all clients to engage in sustainable investment across all funds? Contractually, this is a course that's open, and it's a course that then sets the parameters for the fiduciary obligations to clients as trustees or managers of their funds and investments. So it creates somewhat of a limitation of risk because it aligns the fiduciary obligations with the contractual obligations. So the it's taking me a little bit longer, so let me just jump forward. So I focused on financial institutions, but the same applies to any form of investor, whether we're private investors in hedge funds, private equity funds. Again, the further away you get from the regulated environment, the more freedom you have to contract, to enter into these terms. So let me wind up here. I'm not a financial advisor or even a financial fund lawyer. I'm an international dispute resolution lawyer, although I've certainly dealt with my fair share of finance disputes. So let me, in closing, come to the role of dispute resolution and managing this legal risk, particularly if you embed it into your contract and align that with your fiduciary risk. And P.R.I.M.E Finance, panel of international recognized experts, provides parties with a specialized mechanism for resolving disputes in complex financial contracts. That's why we're half of why we're here today. So all of these agreements, IMAs, service agreements, agency agreements, ISDAs, other standard form or non-standard form contractual instruments, they all have the option not just to include sustainability, sustainable investment responsibility or right, but also dispute resolution through arbitration. And so P.R.I.M.E arbitration is one option in the standard form ISDA. So these obligations can be incorporated in the contracts, aligned with fiduciary duties to remove a lot of the confusion and give investment managers a lot more freedom to make the sustainable investment decisions that they are leaning towards. And an institution like P.R.I.M.E with its financial experts can position itself very well to resolve those disputes, to make sure that the dispute resolution process aligns with the investment strategy.
Okay, thank you, Wendy. I would say one thing on the question of IMAs, and I have seen many IMAs. Some of them are very complex. And we have seen IMAs that do have sustainability embedded in them. Even 5 years ago, the California public funds like CalSTRS and CalPERS were putting extremely specific ESG governance type requirements on managers. So I think we have seen that. Another issue is the fiduciary duty of trustees of pension funds. And in fact, the Impact Investing Institute has done some work on that and come to the conclusion, working with a panel of lawyers, that trustees can invest in impact investing consistent with their fiduciary duty. But fiduciary duty is such an important topic. So thank you for raising it. We have our first question. and that is about disclosure and whether it should be mandatory or principles-based, and how it can be done when there are no consistent principles globally. Who wants to start on that one? Meryam?
Yeah, happy to. I mean, it's a very live topic. So it has been announced by the Chancellor in the UK to mandate TCFD in the UK, which I think is a really welcome move. A huge amount of taxonomy is coming out of Europe, and it's a question of now how will other jurisdictions kind of comply with that or adhere to that. And on top of that, with the kind of federal stance change, possibly in the US, come next year, I think the pressure on SEC, Securities Exchange Commission, to start to incorporate some of those, what's now becoming global standards to be applicable to US listed companies as well. So I think to answer your question, Ida, we need those disclosures to be disclosed by companies to create a level playing field for everybody. And as investors, we want that to be mandatory and not voluntary, because can you imagine us invested in thousands of companies and trying to compare and contrast? I mean, TCFD is bad enough because it's a lot of it's narratives and it's going to be a bit of a messy job. But for that to be voluntary or comply and explain, it's just not quite what we should be doing when we have a huge challenge of having emissions in the next 10 years. That's the challenge we have today. And to say that we don't have disclosure for it, it's just not good enough in the next 1 to 2 years. One thing I want to say is not only we want that to be disclosed and mandatory globally, but ideally the same standard, because what we also don't want is one set for UK, one set for Hong Kong, one set for China, one set for Japan. So again, global harmonization to create a level playing field so we can start to put money into companies that are doing the right thing and perhaps away from the ones who are lagging behind. That's what we want to get to. That's where we want to get to.
You're muted, Ida.
Sorry, somebody had to do it. I was saying that the IFRS has launched a consultation on global standards, which closes at the end of the year, I believe. And we should all respond because it's really a very important topic and could, I think, achieve a global standard. You've got the standard setters engaged as well. But Jonathan, this is your opening to talk a little bit about disclosure and other ESG regulation in South Africa. Would you like to comment on the question?
Yes, happy to comment on that. I think one of the questions that I also picked up was is for in the specific context of public entities. So would you make it mandatory? Is there a mechanism, or is it recommended to make mandatory reporting for public institutions? Which brings me back to our sort of consultation paper that we've got in South Africa at the moment. One of the things that this technical paper proposes is that the recommendations would then apply not only to the local banking market, but to insurance, pension funds, collective investment schemes, private equity, and broadly capital market participants, which would also include public entity capital market participants. And the drive would be as a precursor to regulation. Initially, I mean, the paper speaks to sort of, I call it sort of the Kumbaya model, where, these standards are co-developed and technical standards, guidances, norms are co-developed, which for me presents a bit of a challenge, particularly in our context as an energy intensive country. I mean, as of this year, I think South Africa is number 11 on the list of global contributors to greenhouse gas emissions. And as a signatory to the Paris Agreement on climate change, there's a huge responsibility on regulators to take a more defined stance, I think. Part of the comments that we're putting back to our National Treasurer as a precursor to draft regulation coming out is that due to the inconsistent approach, so if you look, for instance, at the banking and investment space, there's a lot of voluntary behavior that we see in that space. And then your less regulated collective investment schemes and the like, yes, there's proposed regulation in the form of what we call the Conduct for Financial Institutions Bill that's out at the moment. But in the meantime, they fall outside of the formal fold, so there's less of an incentive to adopt voluntary standards. So I completely agree with Meryam that, you know, these sort of disclosures and standards should actually be mandatory. And I think that's where the current paper and proposal presents some challenges. But I think what's really exciting is that it highlights the urgency for a just transition to a green economy and the role that the financial sector must play. So that's very positive. However, I think a lot more work needs to be done around standardizing terminology, behavior, and standards through a mandatory approach.
And Wendy, do you have anything to say on the disclosure issue?
I was just going to say, you know, I agree. Obviously, it's critical, but I was just going to sort of, you know, remind us all how difficult it is to get TCFD mandatory in one jurisdiction, let alone uniform across all parties to the Paris Agreement. And I just want to sort of remind those who are listening about how GDPR unfolded in Europe on privacy. And it took a long time, yes, but GDPR has become a global standard for protection of personal information. And it's a global standard that started with, you know, well-vetted rules in Europe. And what it's become now is a precondition for Europe entering into free trade agreements with other states, that they have that standard in place. So there are ways, once you have it's like that wonderful TED talk on how to start a movement. Once you have a first mover and a first follower, you know, you will get momentum and states will fall into line. And I think we need it to happen that way rather than through the COP process or anything like that, because the Article 6 guidebook would tell us that process is tremendously difficult.
Thank you. And we've got another question from Robert Pickle. There appears that there are layers of law applicable to the instruments, to the issuer parties in countries where the issuer is active or where a project is being built. What is the interplay of all these layers when it comes to rule of law issues? And is it any different from areas of finance that are not focused on sustainability? So anybody want to try to answer that one?
Let me give an opening gambit.
Go ahead.
It's such a cool question and such a loaded question. Essentially, what we're talking about here are either public international law obligations under the UNFCCC and the Paris Agreement, which is binding as between states, not private parties, or we're talking about sustainable development goals and other sort of not treaty or international commitment, but rather guidelines. So how any of these are integrated into any national law system, which it has to be in order to be governing, is going to be a very difficult question from an applicable law perspective. And that's where the Climate Change Framework Acts are so important. That's where that regime of sort of standardized climate statutes and implementing statutes at a national level are so important. But again, you can contract to do anything that's legal, and you can add your applicable law to your contract. And if you want your contract to be governed by sustainable development goals, you could agree to that. I mean, I wouldn't like to be the judge or the tribunal member trying to figure out how to implement and apply that in a dispute. But you know, we have international sale of goods principles that govern contracts. You have general principles of law that govern contracts. So, you know, are there general principles of sustainability? I don't know. I haven't seen them, but you know, it's possible.
Anybody else want to take a crack at that one? No. I would say that in the EU, at least, I've found the regulation is pretty specific on who is supposed to comply with what. And there are certain regimes that apply to financial market participants, and some apply to issuers, and they're very specific. But that's just within the body of EU law, and you've got the other layers, so that doesn't really doesn't determine exactly how it plays out. We have another question from John Taylor. A growing number of ESG standards are emerging for financial institutions. Most are said to be not legally binding, e.g. the Equator Principles. Notwithstanding this, do panelists think that legal risks on financial institutions are growing if they do not adhere to good ESG standards in their financing activities? Jonathan, you want to take that one?
Yeah, so happy to give it a stab, and I think it's a fantastic question, John. I'll just start off by saying I doubt very much that, much as there's an increase in sort of the hardening of the requirement for standards for financial institutions in the ESG space, that there would be too much resistance, because any of the banks and financial services institutions that are not ready and geared to adopt to these sort of principles or regulations for that matter would just become non-competitive in the long term. So first, there's the incentive from that perspective, but I do think there's a hardening and a definite global recognition for the need to develop and adopt a taxonomy for green and social and sustainable finance initiatives. And the only way you can ensure consistency across the board, foster or build credibility and encourage continued investment is through regulating these initiatives. And in doing so, you also then manage your E&S risks that were covered earlier on. So my view would be that there is definitely an increase in that sort of regulation, and it's supported.
Please.
Yeah, I was just going to add how much the legal team and the compliance team is now involved in ESG within my own firm, Legal and General Investment Management. It's just nothing like before. You know, it never really touched them before, the question of ESG or sustainability. And now we have, as I say, sweeping regulations coming out of Europe. So there's a special task forces on SFDR, which is the Sustainable Finance Disclosure regulation. And that's sweeping. That's who we are as a firm and the funds that we launch, wherever we claim to do ESG or climate or a no harm principle. I mean, it's just going to be a huge amount of work to figure that out. And if you don't get that right, it's compliance. It's, you know, we can get sued. And so I think it's become a lot real. I remember not that long ago, and this is a slightly different context, but it's relevant here. We have a big property business, and we wanted to put some solar panels on one of the properties that we owned. And the tenant's legal team just said, no, that's just too much work, just cross that out. And the legal team were almost against us in trying to do sustainability because they had to do extra work, or they, you know, there was just more paperwork that didn't want to go through. And then now I feel like we're starting to be in the same tent, not quite there yet, but about, look, this isn't a nice to have. It's not a page you can just cross and go, not relevant. It's like, no, look, we will get sued, or at least we will have a huge reputational risk for not doing something when we are claiming to be sustainable investor, and then really getting the legal team on board. And so I think we're just at a very, very different stage now. And hopefully that's going to happen in the US and elsewhere as well.
Wendy?
You have laws now like the vigilance law, the Article 159 in France. I mean, these standards are crystallizing into hard law through regulation and statute, but at the same time crystallizing into hard legal obligations through the fiduciary duties, through ESG integration, as Meryam said at the start, but also through contractual sort of commitments and obligations. You know, if you set up an exclusion fund and someone agrees that their money's put in it, it has to be what it says on the packet. Lawyers are, and I won't speak for Jonathan or Ida, but lawyers are, in my experience, always quite slow in coming along with trends and movements. Lawyers tend to be the paperers and the followers of the corporate lawyers, somewhat 5 years later, tend to be the litigation and dispute resolution lawyers. So we do need to bring the lawyers much more into the proactive side of this. And we've always looked at it in the way of managing risk, but that's almost licensed to put a brake on things rather than a motivation to be part of creating and generating the responsibility. So I'd really like to see us find ways to utilize the law and lawyers to move away, not move away from risk, it's important, but also to mirror the risk with the opportunity and how legal instruments create that. And some of the really exciting instruments that Jonathan's talking about and Meryam's talking about, you know, sort of finding ways to get lawyers really bought into those, external and internal.
Yeah, I think you're seeing more lawyers involved with creating policy too. I mean, that was something I did, but I wasn't alone. So that sort of brought them in earlier and made them part of the process. So I think that does help. So I have one last question for the panel, and that is, what do you think the new responsibilities will be of PLC board directors in this brave new world? I'm going to start with Meryam, because I know you engage with PLCs, but I'd also like the rest of the panel to reflect.
What new responsibilities do the boards have today that they didn't have before?
Yes.
Well, to put it bluntly, a lot of countries, including the UK, have committed to net zero. So it used to be that the companies will have its own targets, like we're going to reduce emission by this much, we're going to have this kind of products. And then now what we're seeing is that, no, it's going to be net zero, and this is a trajectory that we need to get to. So what they have is a responsibility of really shifting their business radically for the next 30 years. And otherwise, they're going to be held accountable through regulations, through investors and so forth. It's a very radical way of thinking. And I feel for them, right? Because they still have the short-term pressures of producing returns and meeting investor expectations while thinking through the investments that are needed for the next 5 to 10 to 20 years. So I think we need to start to really think of a way to collaborate together between investors, between companies, between regulators, and all the research and development that we need to do to get there. But I think the biggest question is, you don't set the target, we know where we're going, and you just have to be on board.
Yeah. So we're actually beginning to get some more questions. So I'm going to read the next question from Thomas Jasper, which is a really great question on benchmarks, because I think benchmarks are incredibly important in this area. He asks, are there any relevant benchmarks for how the market values public companies with strong ESG frameworks or penalizes those that don't? And how is this evolving? So would anybody on the panel like to answer that one or give comments on the previous question? Anybody like to take the one on benchmarks?
I feel like I'm over speaking, but I can quickly say that there are a lot of benchmarks now. There are a lot of benchmarks on ESG standards. And what's happening now is that, you know, companies don't own their own reputation. Like, we are starting to really look at a lot of external indicators to see how the companies are faring. For example, in our case in Belgium, we have just sort of scored 1,000 companies on climate metrics on our website. You can come to our website and find out how they fare against standard climate metrics today. And so we're not the only ones. There are many other investors studying the same, and there are benchmarks like, S&P or MSCI and so forth. So I think companies are really aware of how they're seen from outside. And unfortunately, it's not going to be an easy road ahead, but they need to be on top of this topic to stay ahead of competition.
Jonathan, Wendy?
No comment on the current question, but I'll certainly maybe touch on the previous one around board responsibilities in this space.
Yep. Thank you.
Having served as chief legal counsel for what was then renowned, or still is renowned, as the greenest bank in the country, I saw an evolution happen literally before me, where the sort of sustainability ESG team moved from just another team within the institution to actually sitting within the strategy office, reporting to the director and the board members responsible for the strategy of the organization. I think that becomes quite key. I think there's a board responsibility to start steering the strategic direction of institutions when it comes to ESG products in the banking and financial services space. And I certainly think there's a responsibility to look at existing portfolios, and you can't move away from that, right? I mean, you've got what you've got, but directionally, how does that product portfolio tilt over time? And there's always the huge concern around profitability and finance, current balance sheets and spreadsheets as at today, and what does that look like tomorrow? But I think what I foresee and what I'm currently seeing in the local market, at least, is that boards are having a lot more robust conversations around sustainability and not necessarily looking at the current book and how does that portfolio tilt over time.
Just quickly, if I can add.
Sure.
Just remember, the important thing about benchmarking is it's not set in stone. You know, companies that transition, we have to keep open mind with how corporates are responding to transition, and some might be a bit slower off the mark, but then, you know, accelerate ambitions. Others might be straight out the box and then not perform. So I think we have to be a bit open-minded about being able to move from sort of perceived notions on how those benchmarks bake. And as Meryam said, you know, for PLCs, your reputation is not your own, indeed. But your reputation shouldn't be defined by something that's now, you know, 5 years out of date. And so, you know, we should constantly update those. The board, the new responsibility, the biggest one for me is PLC board members understanding the science that is the basis for climate transition. You can't question anything that's coming to you in relation to climate change adaptation or mitigation unless you have a base understanding of the science. It's not that difficult, but you know, there are wonderful little starter packs and things, and I think you can ask the right questions, push back, test. You can prevent yourself as a board member from being fobbed off, you know, blinded with some sciencey answer, if you have that basic understanding of your own. And I think there's a big old responsibility to have that.
That is really a great way to close this panel, and a really practical but essential suggestion. So thank you so much to the panel. You've been fabulous. And to the audience with great questions and for attending. We'd like to again thank our sponsors, DWA Financial Technologies, FTI Consulting, Morrison & Forster, Rudder Associates for their sponsorship of Primetime, and Channel Capital Advisors for sponsoring the session. We'd like to thank Lexis and Nexus, or MLEX, for their support, which has been ongoing during all our Primetime webinars. And if you're interested in sponsoring a future event, we'd really love to hear from you. So please do get in touch. And lastly, P.R.I.M.E Finance Foundation accepts donations through Friends of P.R.I.M.E to support its work. It's a not-for-profit. If you would like to make a donation and to find out more, please get in touch with the Secretariat. The details will be in the chat box and they're also on the website. So thank you so much for coming. It really has been a very, very educational and interesting hour.
Thank you, Ida.
And goodbye for now.
Thank you.
Bye.
Hey.